Though the Finance Ministry has indefinitely deferred amending the FRBM Act, it has reaffirmed its commitment to reduce the fiscal deficit to 4.5% of GDP by FY26. However, the IMF believes India needs to have a more ambitious fiscal consolidation roadmap, cautioning of a shrinking fiscal space amid growing risks to the growth outlook. The multilateral lender has projected India's growth to ease to 6.1% in FY24 from an estimated 6.8% in FY23. India's economic growth faces threats from an imminent recession in the developed world and a slowdown in China, and also from deceleration in tax collections. With this background, should the FM choose fiscal consolidation or support growth through greater capital expenditure allocation? Some experts believe the finance minister should present a status quo budget by keeping the fiscal deficit target unchanged at 6.4% of GDP for FY24 to provide counter-cyclical support to slowing growth dynamics. On the other hand, rating agencies like Fitch have cautioned that rising government debt to GDP ratio from insufficient fiscal consolidation could lead to adverse rating action.
The global economy is going to have significant headwinds and slowdown in 2023. The Indian economy is not going to be unaffected by that. And we believe that we will have a comparatively slower growth rate of about 5 to 5.5%. Given this scenario and the weakness in aggregate demand that is expected during the next fiscal, it will be imperative for the government to continue with the pump priming. It will need to spend and do the productive investments in capex, especially on housing, infrastructure, and logistics, as these have large externalities as well as are job creators. Therefore, the government should demonstrate its willingness to walk the path of fiscal consolidation by having a slightly lower fiscal deficit target than FY 22-23, maybe in the range of 5.85 to 5.8%. But it should certainly not go for a very aggressive reduction in fiscal deficit.
With the government withdrawing the Garib Kalyan Ann Yojana and making the PDS system free for next 1 year, the Finance Ministry will have greater certainty around its food subsidy bill in FY24. This will also help the Finance Ministry bring down its overall subsidy burden by around 0.4% of GDP. However, the lingering uncertainty around the Ukraine-Russia war may keep the fertilizer subsidy bill elevated. The petroleum subsidy bill, which has started to go up again, may expand further next year given the upcoming election season.
How far can the government expand its capex allocation to boost economic activity? This will remain uncertain even if the government saves substantial amounts on subsidy bills and domestic growth remains robust in FY24. There are already question marks about the absorptive capacity of government agencies. Chief Economic Advisor V. Anantha Nageswaran recently said that policymakers need to decide if public sector investment should be scaled up, or should the private sector take over as the main engine of capital formation in the economy.
See, today there is a call for the government to spend more on capital expenditure, and the reason is quite simple. We are not seeing too much of private sector investment. The state governments have their own constraints when it comes to capital expenditure, and therefore onus falls on the central government. And so far we have seen that the central government has been sticking to the target of capital expenditure, and the expectations are there will be acceleration in the coming budget. But if you actually look at the way in which our overall capital formation, the capital expenditure in the country is structured, the central government plays a very minor role. Last year, we can remember the government spoke of 7.5 lakh crores as being the total outlay on capex, of which around 1 lakh crores is actually being transferred to the states, which means that the states would take credit for this 1 lakh crores. Out of the 6.5 lakh crores, we have another 1.6 lakh crores or so, which goes for defense, which is actually outside the purview of the real kind of capital expenditure which you're talking of, which means that around 4.95 lakh crores is what's really there in the hands of the central government for spending on capital projects. If you look at overall capital formation in the country, it's in the region of around 75 to 80 lakh crores. Now, honestly, can this number of, say, 5 lakh crores be driving the 75 to 80 lakh crores? The answer is obviously no. To a certain extent, it can support the overall capital formation taking place in the country. But I think the initiative has to come from the private sector finally. And I think it's time that the private sector reacts to all the incentives which the government has given.
While the Finance Ministry has rejected IMF's contention that the fiscal space is at risk, it remains to be seen how far it can push its luck on the growth front in practice. We will have the answers on February 1st.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.